Welcome to the Banking with Life podcast. I'm your host, James Neathery, and I'm excited to share with you that we've created a new series. This is a topical series where we've taken previously recorded clips, compiled them by topic, idea, and particular concepts within the infinite banking footprint and the financial world broadly. Topics will include loans, loan repayments, paid up additions riders, other riders, dividends, long-term thinking, what could go wrong, what does go wrong within the infinite banking footprint. And I hope you enjoy listening. And it was created for your edification. Thank you. Ringing it every last drop out. Look, I've had agents in the past, they've done that. I mean, I got drugged down the road. Now, it's my fault, right? I'm not blaming people. I got drugged down the road early on of 96, 4, 97, 3. So, I mean, I didn't just wake up one day and say, oh, these guys are bad people or whatever.
And the only reason I didn't go down that road is because I learned from him.
So, look, I had an agent one time doing exactly what, you said or talking about. Look, here's the MEC limit. And I've seen other agents, they would pride themselves. They build those. I got within one penny of the MEC limit, like they really did something, right? Well, hell, they just knew how to manipulate the software.
Yeah.
Okay. And a different individual, ringing it out, going right up, I got within $10, because the more you do that, the more funky fragility things that you cause in the future that illustration's not showing. But in actual factual experience that these guys haven't paid a premium long enough to know, it's going to happen. Okay. Anyway, this one particular agent, great guy, he thought he was doing the right thing. I didn't know that he was doing the wrong thing. I'm like, yeah. He got down. He's like, listen, here's the MEC limit. It's like, whatever, $20,010 is the MEC limit. I've got this policy built right up to $20,009. I'm going to send the life insurance company $20,012 to see if they catch it.
Oh, gee.
That's the same kind of thinking, though.
It's the same kind
right?
of thinking.
And it's like, wait a minute. The life insurance companies are bean counters. They spend millions of dollars on the illustration software and the maintenance of it. And I'm not saying they're squeaky clean, and I'm not shilling for a life insurance company. It's like, why would you do that? And Nelson said, quite frankly, he said, you just want to go up to the MEC limit, and, you don't want to wave a red flag in front of the bull. And now, too, once you get past this fear of illiquidity, paying a premium, once you get past that, because that's fear-based, right? Once you get past the fear of having a professional that you work with be profitable, oh my gosh, I want a lawn care service. Let's just get the guy with the cheapest price. Therefore, he has the cheapest equipment, right? And the cheapest employees if he has any. And then And I'm not talking about lawn care. I'm talking about grass cutters. Okay, I mean, I have a beautiful lawn care people. I'm not disparaging it. I'm talking. Some of it's belled, sir. Okay. My point is, like, if you're going to go buy a suit, do you want the cheapest suit that you can possibly? How about shoes? How about an automobile? How about a gift that you're giving to someone that you love and care about? Do you want the cheapest thing? Do I want them not to be profitable? So if something goes wrong, I don't want them to answer the phone. If they will, if they're still available, and I'm not saying everybody who does nefarious things goes out of business in short order, but just give them time. And this is more of a statement. Peter says, gentlemen, I disagree partially with your view on blended policies. In the view of someone starting out in poverty, early high cash values are important to start using this IBC ASAP. It's an opportunity to accelerate their first policy. Also, level convertible term can start being converted, fixed term premium, parentheses, whenever extra money is found. This will get them going strong and fully banking sooner. By converting term whenever possible, their policy efficiencies can potentially be upgraded as well. This reduces MEC, Modified Endowment Contract, risk. In parentheses, a good company will help you avoid this anyway, and transition into banking the way Nelson intended faster. I enjoy your podcast videos very much. Thank you for helping spread the word. Well, Peter, thanks for your commentary. I appreciate it. And you're perfectly free to disagree, as I am, because I disagree with most all of your statements. The blended PUAs are blended PUAs. A blended PUA is a PUA rider, paid up additions rider, blended with term, 1 year renewable term. And is a 1 year renewable term in a blended PUA convertible? I think not. And so a couple of things. When somebody is starting out in poverty, listen, poor people have poor ways. So if you don't have any discipline, the infinite banking concept is not for you. It is okay to be stable before entering into this idea and practice of paying life insurance premiums. Now think about that. If you don't have any money, the infinite banking concept is not for you. You want to go borrow money, be beholden to the third-party lender, you're violating Nelson's 4 fundamental rules, right? Number 4 is don't be dependent upon third-party lenders, right? Don't do business with banks is what he said, other than savings and checking. And poverty is just damn near a state of mind too, okay? So I'm just saying that you got to have capital, right? And so once you have capital, are high early cash values important? Of course they are, no question. But if poor people don't do something for the next generation is going to be poor too. Right? Okay, so and I just kind of talked about death benefit is very important. So high cash values are good. Capital accumulation is good. And when you say start this IBC ASAP, what does that mean? As soon as you pay a premium, you've started. It's becoming your own banker, right? And poor people, we all need cash reserves, right? Emergency fund. We all need access to capital. So and I'm in a hurry as much as the next guy, right? There's plenty of time, but none to waste. I get it. And if you don't have time to do it right, you sure as hell don't have time to do it over, right? So I don't understand this idea of, what are we going to sacrifice? You do not want to sacrifice the integrity of a policy just because you're on a short timeline, all right? I mean, somebody that's 35 years old and still in poverty, what have you been doing the last 35 years? All right, it's okay to take a couple of years to correct a 35-year bad habit, right? Okay. Also, what is it? My wife Jan and I were just talking about this last week, and we talked about it previously many times. It's the days are long, but the years are short. I mean, I get the idea that we need to get going. I get it, but you don't want to jeopardize the integrity of a policy to compensate for 20 years of bad mistakes, okay? And when you don't structure a policy correctly, it is not going to serve you well over your lifetime. And these are life insurance policies. So I have a life insurance policy. It's going to mirror my life. Go figure. Let's just think that through, right? I bought a life insurance policy on myself, okay? It's going to be complete, fulfilled, pay a death benefit when I graduate. My whole life, I'm going to have that asset. What year do I want to sacrifice in the future to get started in a hastily manner or to have an improperly structured policy? What year do I want to sacrifice in the future? What policy year in the future do I want to sacrifice to go cash on cash, in year 2 or 3 or 4? I'm listening, right? None. I don't want to sacrifice any year. None. Okay. Also, level convertible term can start being converted. Fixed term premium. Yeah, of course, whenever extra money is found. Well, listen, with this idea of finding extra money, I mean, if you have any extra money, send it to me. I don't know anybody that has extra money, right? But yes, convertible term, can be converted. Perfect. Not from a blended PUA, right? And it shouldn't be willy-nilly, right? Your expansion, that would be an expansion. If I start a policy today and I convert term later, isn't that an expansion of my system? Yes. So if my first policy is built correctly, I'm not forced to expand my system prematurely. It'll be a natural expansion. It'll be apparent to me, and some are slower than others. I'm probably the slowest guy on the planet, right? But it becomes apparent when I should expand. All right? Okay. And I prefer, personally, standalone term riders for part of that reason. So you can convert the term in the future if you choose to. But if you don't choose to, you're not being forced into purchasing another policy. And whenever you have that high cash value, I know I'm doing sign language now for you listeners, track down the video, or maybe we'll have this in content released by the time this is aired. The XY scale, the higher the premium I pay in the early years, the shorter the duration that I can pay a premium. Okay? Whenever you build these blended PUA policies, you cannot pay a premium for a long time period. You can't. Right? And then the more fragile it becomes in the future. So, okay. All right. This will, you convert the term when extra money is found. This will get them going strong and fully banking sooner. No, a correct foundation is the most important starting point, period. If you have a weak foundation, whatever you build on top of that structure is not going to do well. All right. So, a correct foundation is the most important. That's the best thing a poor person can do. By converting term whenever possible, their policy efficiencies can be potentially upgraded as well. Man, listen, a proper expansion of a banking system is correct. The policies all become more efficient with time. If you try to artificially shorten that time for artificial efficiency in the early years, you're jeopardizing years of that policy in the future. And you don't want to MEC today, you don't want to MEC in the future. You want to pay a high premium today, it's not going to change. If you have the ability, you want to pay a high premium in the future. Now, if something unforeseen happens and the future is absolutely unknown that causes you not to be able to pay a high premium, then your policy should be structured where it still performs very well for you and your family. And that's where a knowledgeable practitioner comes in. These individuals that practice this concept associated with the Nelson Nash Institute know what they're doing. These marketers that are not affiliated with the NNI should be stepped over. You should walk right past them. You should listen to them. As Jim Rohn, everybody can be an example or a warning, an example of what to do and a warning of what not to do. So if your practitioner, your professional is not associated with the NNI, you should bypass them. My opinion. And then they should, if they're not affiliated with the Nelson Nash Institute, they should go through that process to become affiliated, right? They have a process. And not everybody gets through, thank God, all right, and can be a practitioner. Again, Peter, thanks for your commentary. It helps me share. Okay. The policies become more efficient, as upgraded as well by converting the term. He continues, this reduces the MEC, Modified Endowment Contract risk. A good company will help you avoid this anyway. A good company is not going to do anything but send you what's called a MEC letter. They're not going to call you and say, hey, Peter, you're getting close to getting to a MEC. Don't pay over this amount. You should know what the MEC limit is on your policy, and you shouldn't go above that amount in premium. If you do, the company is automatically going to send the owner a modified endowment contract letter. And it's going to say something like, hey, we received your premium. Thanks for being part of the smartest people on the planet by sending us a life insurance company money. However, this premium has caused your policy to MEC. They have to notify you of that, right? So then it's your choice. You're going to accept the MEC. If you don't respond, it's going to be a MEC, and a MEC is a MEC is a MEC. You'll never be able to unMEC a policy, right? And I think the IRS gives you 1 year. Most companies give you 6 months, but you shouldn't waste any time. If you get a MEC letter, you should call in right then. And your choices are going to be, just keep the premium. I love a MEC, which you shouldn't do that. If you can avoid it, you shouldn't do that. You don't want a MEC policy if you can avoid it. Okay. Then you can tell them, send me the premium back that caused my policy to MEC. They'll send you a check. You can tell them, well, pay down a loan, apply that additional premium that caused my policy to become a MEC, and reduce the loan. right? It's your choice. So I'm just saying that a good company, man, what does that mean? It's going to help you avoid a MEC. No, don't be dependent upon the company. You, the policy owner, should know what your MEC limits are, and you should pay a premium every year right up to that MEC limit. Okay, my opinion. Okay, and then he continues. And a good company, and if you convert the term and avoid the MEC, and this will transition into banking the way Nelson intended faster. No, I think I've really pretty much all addressed that earlier. And then he says, I enjoy your podcast videos very much. Thank you for helping spread the word. Okay, thank you, Peter. I appreciate, again, you posing or sharing your comments and giving me the opportunity to share mine. Okay, and I appreciate you listening.
Talked last time about this audience capture idea, right? The agent's captured by the...
I love that.
Yeah, it's great. And there's more to that, right? But, bigger number, faster, sooner, whatever the title of that was. And that's what the audience wants. So the agents are going to give it. So, because the agents are captured by the public that just wants bigger, faster, better, sooner, right? Well, then the next layer is the agents go to the companies to say, look, we need, we got to meet that need. I'm going to be able to provide, I need a high early cash value. Heck V. I need an acronym, something. And so then the companies provide that. And then they get into the actual experience and come to find out how all that happens. And at everything you were just going through there,
you listen to an agent.
It just dawned on me. It's like, the 1090 thing is not just a MEC issue.
No,
there aren't just modified endowment,
but they
tax
exist.
Status problem, right? Those are problems. Those are legitimate problems, and those do affect the design. But that isn't. There's the modified, and I've thought about this before because I would go down the line of thought. What if we didn't have modified endowment contract rules at all? You could go buy a single pay whole life, and it's no problem. Would there be any base premium? As we think of it today,
fair question.
Paid anywhere ever by anybody. Yeah. Could that even be an offering? Would that make sense long term? And where I eventually came around to, it's like, no, you can't. It's got to be the relationship, like on a PUA rider premium payment. There's an expense charge. There's a administrative cost. There's a
death benefit cost,
a facilitation cost. And there's an economic cost to a PUA premium, and the death benefit you get relative to the premium payment you make is fairly small, relative compared to a 1 year base premium compared to the initial death benefit.
Absolutely,
right? Compared to that,
it even got smaller since 2022. Yeah.
My point is, I think you have to have this long-term type structure. You've got to have the initial illiquidity. The companies can't economically, they can't do everything you just talked about. They can't pay a dividend and pay the agent who placed the policy and services the client.
And that's in the early years. They can't pay a freaking death benefit.
There you go.
Okay, they can't guarantee with certainty. So you can't separate those. Guarantee a future value.
Yeah. This is where this goes, right? And this is how they mitigate, talking about trade-offs, this is how they mitigate all of that uneconomic proposal. You can't pay everybody. You want 100% liquidity and a dividend, and we're going to pay to do all that. Where that goes, the way the companies piecemeal patch that up is to mitigate the liability, to build in ways to reduce the freaking death benefit.
We've talked about this from the day one, no question. That's a whole. We could spend the whole 2 hours on that. The concept of insurance. I'm a homeowner. You're an insurer. You're a fire insurer. I don't want my home to burn down, and I can't afford to rebuild the whole thing today. So let me pay you a premium to insure against that inability to replace my home because I don't have the money in case of a fire. I am paying you to receive, and I'm offsetting that risk of loss. And it for a premium, right? And all the calculations, take all the homes and all that large numbers. The same thing in life insurance. It's 100% guaranteed that we're all going to graduate. Man, if you're the one that's not, I might want to have a conversation with you. No, I really don't. If you feel that way.
If you feel that way, yeah.
So it's just a matter of time.
Yeah.
When? Who knows? The future's unknown. But statistically, they can tell you exactly how many 55-year-old men are going to die 2 years from now. Right? Okay. And my whole point here is that I'm going to pay you for an eventual event. It's a guaranteed event. And so you've got to price all that together, which includes persistency, dividends, the expected rate of return on guaranteed products, bonds, blah, 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 because the death benefit's guaranteed and the future cash value is guaranteed. All right. So, and then I want you to remain profitable for these 150 years. Not that I'm going to live that long, but my grandchildren might be here if I ever have any. So I want you to be here, if I'm going to do business with you. Then how conservative do you have to be? Right. Much more. And I'm as conservative as they come, but you've got to be uber conservative. Well, I'm okay with that if you're talking about my money or the money that I have a guaranteed contractual access to once I hand it over to you. Because once I pay a premium, it's not my money. But I have a guaranteed contractual access to it. Well, who's backing up the guarantee? And that's important, right? We've been talking about it all this long time. And I've got a guaranteed access, contractual access to that capital that I just paid you in the form of premium. Then I want you to be conservative. So from that point on, they are going to mitigate every possible chance that they have, the possibility of something going wrong. Paying a claim too early, right? They didn't do underwriting. I lied to them on the application. They didn't catch that through their 100-year-old developed process. And I smuggled it in the back door, right? And then statistically, people die, what have you. They're not going to do anything that helps the adverse selection against them.
Right.
They're not going to do anything to increase the risk that I just paid them to take.
Yeah.
Everything they do is going to mitigate. So, well, okay, James, now you being all, okay, well, whatever, just follow me on this. With the PUA, right, you look and there's several structures of PUA. What ultimately happens to that death benefit in the future? On all PUAs. Blended PUAs.
It goes away.
Blended PUAs. It goes away or decreases dramatically. The closer you get to natural mortality, whatever it is, statistically for all of us, each of us, the death benefit goes down. That's a hard win for the life insurance company.
Yeah.
Well, James.
That's how it gets paid for.
Okay, so, but no, here, okay. So just looking at the cash value of a whole life policy on the base premium, right? We use a base, put all the riders on there. The cash value must equal the face amount at 120. We get that, no problem, right? You get that. We've talked about it many, many times. And then it pays a dividend. The dividend, if it's allocated to the PUA, purchases more death benefit. So you have an increasing death benefit. And you therefore must have an increasing cash value because they have to equal at 120. Okay, well now let's just overweight the PUA. Let's stuff as much PUA premium compared to the base premium as we possibly can in the policy. And then we've talked about MEC issues all the time. Then you have these other groups that say, oh, I've got an illustration and it doesn't MEC for 30 years. Like, oh my gosh, really? And you're selling your own self that stuff, man. You're a good salesman, but you're the only damn customer that believes it. There's a special place in my heart for agents, but you need to step up and deliver because this is not a game. Dealing with people's money,
their lives.
It's just so not a game. And I might have a good healthy dose of I'm over the gamification of the infinite banking concept.
Yeah.
And so it's like not very far under the surface. So you're being a gentleman, and I appreciate that. Somebody's misunderstanding, misconception, or they're trying to sell something, or maybe they don't understand it to the level that they should to quote unquote teach or promote.
Yeah.
So.
Well, we'll often see people with a large sum of money, and they take it to an agent, and the agent will try to put all of it into a policy year one. And they'll, max out a PUA, and they'll do, 95.5, right? A bunch of premium to the PUA.
Talking about
very
the
little
structure
base
of a policy.
That's right.
They're contorting the structure to accommodate,
a large premium because people can't. Let's say maybe I can pay $5,000 to $6,000 a year in premiums, but I have $150,000 sitting there. Yeah. Like you
and
can't.
My mortgage is $125,000 and I want to pay it off tomorrow.
Exactly. So what agents will often do is, just chunk all of that into a PUA, make the base what you can cover every year, and then everything else goes into like a SPUA or whatever. Like there's a bunch of different PUA riders out in the big wide world, but they'll put it into a PUA rider. Yeah. And it's just not the right way to do it. We were talking also about people talking about expanding their income or expanding their systems to accommodate all of their income. So specifically talking about everything I earn, I put into a policy.
Yeah, and premium income should equal premium.
Yeah, that's common. We see that all the time out there. And what we often would say is like, you know what, you have all this money, you want to go spend that money, go spend the money. Don't just try to fit it, everything into a policy year one. That can harm a policy. That can, harm what you're trying to do with a policy 5, 6, 7, 10 years down the line.
It has results.
It has a negative result on the policy every time.
There's really a lot here, and we've already, before the cameras really started rolling, we've already sketched out a couple of upcoming topics, and one of them would be the misunderstandings or misconceptions, however it's titled. Yeah. And there's a lot of them that are prevalent, and they're persistent. They continue to exist within the infinite banking footprint, which is fine. It is what it is. But a broader story should be told. The whole story should be told, or at least available. Yeah. And so that'll come, and I'm sure that'll show up on one of the topics, and there's the least amount of death benefit. And I'm guilty. I said it 20 years ago, trying to get the least amount of death benefit, as much cash value. Well, that's, you can say it that way. Is it really correct? It would be more correct to adhere to Nelson, where he says de-emphasize the death benefit and emphasize the cash. That doesn't mean the least amount of death benefit possible at all, and then that extrapolated over time and across, the infinite banking footprint is what I call it. It's a misunderstanding. Yeah. And so it's somebody's misconception of Nelson's work, and then people grab onto that, and then they have their own misunderstanding of Nelson's work. And then because I could go on and I could talk for 2 hours on the benefit of the death benefit, but I'm not going to here. I'm just saying our conversations occur every day. What we see, what we experience, what we hear from clients, from prospective clients, from agents. Because, we speak to a lot of agents. We try to help everyone we can. We cannot help them all. But we make an effort to help where we can. But today was really going off of the idea of all this money up front. And I thought in my mind, let's just look at the life insurance industry generally. Today, MEC is a topic, Modified Endowment Contract. We typically structure policies within the infinite banking footprint to avoid the MEC, the Modified Endowment Contract, because once a policy becomes a MEC, then it's always a MEC, can't be unMEC'd, and that changes the tax treatment, right? And the taxation on a MEC is LIFO, last in, first out. So it's taxable when you borrow money, withdraw money. And so if you can avoid it, Nelson said, if you can avoid it, you should, but a MEC is not the end of the world. Okay. But if we go back in time, I think it was 1988, and it's always a technical bill or adjustment to the tax code, right? Well, it occurs all the time, but I believe it was in 1988, and I could be wrong. It's 86. I believe it was 88. Whenever the IRS, came up with the MEC guidelines, right? And then there's a whole history behind that. We've talked about that on this podcast, and shortly, or just short order, back in the 80s. A lot of other things occurred too within the life insurance industry. There's a demutualization. These mutual companies were demutualizing into stock companies. There's lots of reasons for that. And a couple of them would be, all the Wall Street guys showed up and they want to run. The life insurance companies have all the money. Okay, they have all the money, and it's real money because they can't print money out of thin air like a bank. And so there's all these great, huge pools of capital. What Wall Street guru wannabe wouldn't want to get a hold of that? And it's going on today, and the current narrative is all the credit situation. Yeah. Okay, I don't want to chase too many rabbits. The bottom line is, back in the 80s, these mutual companies were demutualizing. There's several reasons. They wanted to compete with everybody else. You had Ralph Nader and all these do-gooders. I'm going to save the common man from these gangster capitalists. They're bad guys. You have the people that say, term is cheaper. Whole life is complicated and expensive, and all these. I have a book over there. I mean, that argument, term versus whole life, is over 120 years old. It's nothing new, right? It was just, it has a new iteration or a new version, a new voice, as time goes through. It's all cyclical.
The dangers of the noise out there, because there's just one in particular thing that I keep seeing in my feed everywhere about, and it's probably because of the things I research, but maybe not everybody's coming across this, and it's just me, because this kind of like stuff I like to do for fun. And I like to look at ways to save on taxes and things to write off for my businesses and so on and so forth. But this IUL thing is just getting pushed all over the place by these young kids, influencers, don't know any different. Like, they're probably into that company that I almost went to, pushing this. And what I remember hearing when I watched the videos about, it was somewhere Nelson said that these things are like zombies because at some point they eat themselves. And I'm like, these are so dangerous. And so I put comments out there under their videos to be like, hey guys, just, have you thought this through?
Do you get beat up? Do you get attacked?
A little, but yeah. I'm trying to flip them.
Yeah. It's I'm a pretty busy guy, relatively. And it's entertaining for me sometimes when I look at the comments on different life insurance, whatever it is, when it comes to life insurance and IBC or whatever, infinite banking, on social media, to stroll through the comments, man, it's like the blind leading the freaking blind.
So true.
I'm not surprised, but you said dangers, and I knew she wrote down IUL before we turned the mics on, right? And I told her that, I have 3 short videos that I talk about IUL on a very 30,000 foot view of what's wrong with them and why they're wrong and what's likely going to happen. But then I also shared with her, and I'll share with you now, that, I'm currently in the middle of doing a very in-depth dive into IUL, because I see it all the time too, and see these young people, God bless them, they don't know what they think they know. And then you have the guys in the IBC world or in the world of infinite banking, and they slam on the guys, the infinite banking or whole life. They slam on the whole life guys as if they just don't know, right? If you structure it just right, then all of those things don't happen. And it's the same argument that in the world of infinite banking, we're trying to go cash on cash as soon as possible. So you have to contort the policy structure, and they don't know, or they don't care the fragility that adds to a whole life policy. So the IUL guys that are saying, yeah, you can do infinite banking with IUL, they don't want to mention what Nelson wrote about IUL and becoming your own banker. And he mentions it. There's one page there he mentions that he'd never sold it, and he certainly wouldn't buy it, quote unquote. But it's the same argument. Well, those guys don't know how to structure it just right. So it's like the financial agent guru, have discovered a life insurance company's software to build an illustration, and you can manipulate the numbers so it never shows a MEC, right, or whatever. It's the same argument, just applied to a different product.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.